David Kelly is Chief Global Strategist at J.P. Morgan Asset Management. He joins us to watch the global economy heat up. David, welcome.
Glad to be here.
And let's shoot to our first question. There are still enormous amounts of liquidity from central banks. Mm-hmm. How does that affect investment and?
Well, I think you have to separate the economy from the markets. I think that all this liquidity from the Federal Reserve, from the ECB, the Bank of Japan, actually has not done that much to promote economic growth. The problem is really one of lack of confidence in many countries, not a lack of liquidity. But what it does have a profound effect on investments, because 86% of the money that is invested in stocks and bonds in the world is invested in countries where the central bank interest rate is below 1%. And what that means is that savings rates are below 1% in terms of interest rates. So in order to have a good long-term investment, all you've got to do is beat zero in all of these countries. So what I think it does is it helps risk assets throughout the world, and that's one of the reasons why last year was such a good year for equities.
But is there no risk with the tapering or the beginning of the tapering that interest rate rise, particularly if the US economy grows faster than anticipated?
Well, I think long-term interest rates may go up a little bit more in the United States, but certainly not to high levels by historic measures. Because when central banks hold short-term interest rates low, there's a limit to how much long-term rates can go up. There's a limit to how steep the yield curve can get. So I do think that interest rates will rise, but that's not a bad thing for economies, or not that bad, I think, for economies, because what people do is they tend to try and borrow money ahead of interest rate increases. Mm-hmm. So I think the US economy will actually grow more strongly even as interest rates rise during this year.
And you are quite a fan of European equity. Mm-hmm. And why is that?
Well, because if you look at the world capital markets, US equity markets are now back to new all-time highs. But if you look at the MSCI Europe, it isn't actually at an all-time high. It's well below where it was in 2007. So if you look at price-earnings ratios, and if you look at dividend yields, it's cheaper than it was back a few years ago, and much cheaper than it was 10 years ago. But also the European economy has not really begun to recover. It's just springtime in Europe. You know, it's early spring. We're seeing some improvement in Germany and the United Kingdom, but with the unemployment rate at 12%, it will take years to get to full employment. And I see these next few years, next 5-6 years, as years where unemployment in Europe comes down to 6%, 7% for the Eurozone overall. That means a lot of economic growth, a lot of earnings growth, and ultimately a lot of growth, therefore, in European equities.
But do European enterprises, companies have that potential to grow? Are they too frail? Do they have the markets?
Oh, they absolutely have the potential to grow. I think they've got the potential to grow in Europe, for one thing. And also a lot of European revenues come from emerging markets outside of emerging markets and other global economies. So European companies aren't just dependent upon the European economy. I think they'll benefit from an improvement in the global economy. But what I think a lot of people are missing is the potential for Europe itself to improve.
Will the US tend to close itself on itself with the energy independence, for example?
I think it will over time. I think it's a very interesting geopolitical issue because the United States has always had a huge involvement in the Middle East, and usually that has hurt the United States. It's not an easy place to operate. So I think the United States will probably reduce its defense spending, reduce its engagement in the Middle East, and that will have an effect on the United States. It also makes the US economy less vulnerable to the next oil shock. So for the US, this shale gas and shale oil is a very big positive.
And just a word about Abenomics. Mm-hmm. How is that going forward? You seem to be quite confident.
I wouldn't say I'm quite confident. I think it is the right thing to do. I don't think that Shinzo Abe or Kuruda-san, the central bank governor, had any choice. They've tried to devalue the yen. They have got Japan growing. They've got inflation rising. The problem is they still have a very big budget deficit and a huge amount of debt. And the moment of truth for Japan will be in April when they have a sales tax increase. If that puts Japan back into recession, they are in terrible fiscal trouble because they cannot afford, financially, they cannot afford to go back into another recession. I think they'll probably avoid it, but there is a lot of risk in Japan. There's more risk in Japanese debt, I believe, than in European debt or in US debt.
And last but not least, because I know you're very optimist on that market. What about emerging markets, which are not favorite at the moment?
No, emerging markets have had a very rough start to the year. And emerging markets will always be volatile. And investors should think about emerging markets as part of their investments, not all of their investments, and they should be patient. But to me, the most important thing about emerging markets is this: they have the potential to grow. They are the land of the young. If you look at the developed world, Japan, Europe, the United States, all of the populations, the working age population is actually beginning to shrink. But emerging markets have the potential to grow their working age population, to grow capital investment, to grow productivity. They will lead the world in economic growth over the next 10, 15, 20 years. And now, because of 3 bad years for emerging market stocks are very cheap based on price to book or price to earnings. So I think this is actually a time to get into emerging markets selectively. You have to have good managers who can avoid some of the potholes, and there are many of them in emerging markets. But I think it's a very good time for long-term investors to get into emerging market investments.
That doesn't apply to China, though, where the population is aging as well.
That's right, and China does have some more have more significant problems. They have a demographic problem because of the one-child policy, which has limited the number of new workers, and they have a very difficult adjustment from a manufacturing-based economy to a more consumer-based economy. Chinese stocks are cheap, but I do see more problems in China. So I like emerging markets actually outside of China.
David, thank you very much for joining us today.
No, thank you for having me.